reported GAAP revenue grew just 7% year over year, yet the Coca-Cola Company engineered a 17% explosion in diluted earnings per share to $1.03. How does a legacy beverage giant squeeze that much profit out of a single-digit sales bump? Or is this an accounting illusion? Consolidated GAAP net operating revenues hit $13.38 billion for the second quarter, masking a structural shift. Examining the diluted earnings per share of $1.03 reveals the reality of immense operating leverage. Management runs a masterclass where incremental sales bypass heavy operational costs and fall directly to the bottom line. The firm is capturing genuine value rather than just keeping pace with the 3.5% annualized US inflation consumer price index. The company saw its operating margin expand by 77 basis points to reach 34.9% in the second quarter. At first glance, the street assumes the business aggressively cut marketing spend to temporarily boost the quarter. However, this profitability enhancement stems from a strategy to shed heavy physical infrastructure, like massive syrup vats and local bottling facilities, across emerging markets. By shifting toward a capital-light model, management cements pricing supremacy over systemic supply chain costs. This brings us to the real issue regarding capital intensity and the ongoing return on invested capital profile for the firm. Divestitures of asset-heavy bottling operations in India, Africa, and Nigeria are fundamentally altering the structural DNA of the Coca-Cola Company. Daily financial headlines focus heavily on the temporary loss of gross volume, missing that this allows the business to focus exclusively on pure-play concentrate production and brand intellectual property. This strategic shift makes the stock highly attractive for efficiency-focused portfolios looking for defensible cash flows. Reshaping the physical supply chain works only if consumer demand holds, leading to the non-GAAP organic revenue growth of 6% for the quarter. Most analysts remain captivated by the $13.38 billion in reported revenue, but this metric strips away foreign exchange noise to reveal true consumer loyalty. Notice how global shoppers willingly absorb higher shelf prices for physical cans of Sprite and Diet Coke without abandoning the core brand. This behavior validates a highly defensive product portfolio that commands serious pricing power regardless of the economic environment. This pricing power fuels a formidable liquidity position, generating a non-GAAP free cash flow of $6.86 billion in the first 6 months. Retail investors often track only top-line beats, but this massive financial cushion protects the business against macroeconomic shifts and global uncertainty. Looking ahead, management projects a full-year 2026 free cash flow target of $12.4 billion. Grasping this cash generation capacity changes how you view financial reports, signaling ample liquidity to sustain aggressive dividend payouts and potential share repurchases. But even a financial fortress has vulnerabilities, with foreign exchange currency impacts acting as a severe drag that eroded operating income by 8% in the second quarter. The prevailing view suggests the Coca-Cola Company is immune to global market volatility. Yet this invisible tax proves otherwise. To combat this drag, the firm relies on non-designated economic hedges, adding a net impact of $56 million to non-GAAP income before taxes. Despite executing flawlessly on the ground, broader global monetary dynamics are quietly taxing its underlying United States dollar success. This tension between local execution and macroeconomic reality is most visible in specific emerging territories. Latin America reported a staggering 15% year-over-year revenue growth, leading all global business segments. At face value, you see a booming market, but look slightly closer and you find a striking financial contradiction. The company simultaneously recorded an impairment charge of $40 million related to an equity method investee in that exact same region, plus an additional trademark impairment of $31 million. Management captures explosive top-line momentum, yet deteriorating operational projections necessitate these sudden write-downs. To counterbalance these regional complexities, the firm leans heavily into its most reliable weapon, Unmatched brand marketing, leveraging massive cultural moments like strategic hydration breaks during global soccer tournaments, directly boosted consumer engagement. This visibility translates directly to the bottom line, driving the 7% year-over-year growth in GAAP net operating revenues. By deploying advertising around physical sporting events, the business weaponizes capital to construct an impenetrable economic moat. This strategy actively lifts sales for peripheral brands like Powerade and captures immediate market share from competitors. Still, brilliant marketing cannot shield a business from modern operational threats, like the recent ransomware event targeting the dairy subsidiary. This event severely tested the resilience of the digital and physical supply chain infrastructure for the Coca-Cola Company. While casual investors often panic over production halts, existing physical inventory buffers ensured retail shelf space remained fully stocked. This market continuity and rapid recovery underscore a highly sophisticated, shock-resistant operational framework that protects the $25.85 billion in six-month consolidated revenues. Sustaining this remarkable resilience requires an agile internal culture, which explains the transition of the new chief executive officer toward decentralized decision-making. Casual observers often dismiss executive leadership, shuffling as standard corporate bureaucracy. However, this management move aims to accelerate digital transformation and drive market proximity. By pushing authority closer to consumers, the firm disrupts its legacy structures to secure its 9% six-month revenue growth faster than rival legacy brands. But beneath these operational victories lies a hidden variable that very few people are properly pricing in. An unquantified regulatory risk currently looms over the balance sheet regarding ongoing tax litigation with the United States Internal Revenue Service. The company routinely excludes the potential financial impact of this dispute from its adjusted effective tax rate metrics, which stood at a GAAP effective tax rate of 18.9% for the quarter. This creates a massive blind spot for investors, who must weigh a regulatory shift that could instantly disrupt the cash flow outlook. So, is the broader market entirely wrong about the underlying fundamental strength of this beverage giant? The ultimate verdict is that the Coca-Cola Company remains an absolute masterclass in defensive growth and capital allocation. While unresolved tax litigation and persistent foreign exchange headwinds pose genuine risks, the core economic mechanism of the business is undeniably robust. By shedding asset-heavy bottling plants and leaning into a pure-play concentrate model, management permanently elevated baseline profitability. The firm is currently generating an immense free cash flow of $6.86 billion, providing an absolutely unmatched margin of safety. As long as the physical brand maintains its widespread cultural dominance, the company will relentlessly reward its shareholders. Do you think their elite pricing power can indefinitely outrun the hidden currency and regulatory risks? Let me know in the comments. So hit subscribe so you won't miss what's next, and jump straight to the next video, because that could be the very insight you need to get ahead.